How does the Tax Cuts and Jobs Act relate to supply-side economics? Have you ever wondered how tax policies can shape an economy? The Tax Cuts and Jobs Act of 2017 is a prime example of this connection, especially through the lens of supply-side economics. So, how does this act fit into that framework? Supply-side economics is an approach that focuses on reducing taxes and regulations to stimulate business investment and economic growth. The idea is that lower taxes create incentives for individuals and companies to work, save, and invest, which can lead to a more productive economy. The Tax Cuts and Jobs Act aligns closely with these principles in several important ways. First, the act lowered the corporate tax rate from 35% to 21%. This significant reduction aimed to make American businesses more competitive on a global scale. By lowering the tax burden, the hope was that companies would invest more within the United States, creating jobs and driving economic growth. Next, the act also reduced individual income tax rates across most brackets. This change was designed to increase disposable income for many Americans. With more money in their pockets, individuals would be encouraged to participate more in the labor market and boost productivity. Another key feature of the Tax Cuts and Jobs Act was its provisions to encourage the repatriation of overseas profits. By offering a lower tax rate on profits brought back to the United States, the act aimed to stimulate domestic investment. This could lead to more capital being available for businesses to expand and innovate. Additionally, the act allowed for immediate expensing of certain capital investments. This means businesses could deduct the full cost of qualifying equipment and infrastructure investments in the year they were made. This provision encourages companies to invest in their operations right away, rather than waiting for tax benefits to accumulate over time. From the perspective of the Republican Party, these changes were seen as a way to remove tax-related barriers that had previously hindered business growth. By lowering the cost of capital and increasing after-tax returns on investments, the Tax Cuts and Jobs Act aligns with the goals of supply-side economics. The idea is that, by promoting business investment, the economy can grow in a sustainable way, leading to higher wages and improved living standards. While the initial effects of the act included a boost in overall demand, its primary focus was on enhancing supply-side factors like investment and business formation. Republicans view the Tax Cuts and Jobs Act as a practical application of supply-side theory, aiming to create a more dynamic economy by tapping into the potential of the private sector. In essence, the Tax Cuts and Jobs Act of 2017 embodies the principles of supply-side economics by cutting taxes to reduce barriers to investment and work. This approach is intended to encourage economic expansion, job creation, and ultimately higher incomes, reflecting the core beliefs of conservative economic policies.